Welcome back, everyone, to Vox Markets. My name is Paul Hull. I'm delighted again to be able to speak to Jamie Constable of Singers, one of the UK's finest capital markets experts. So welcome, Jamie.
Hi, Paul. Great to see you.
Yeah, well, after sort of like Friday's blowout job report, which was sort of double expectations, that's sort of suggesting the economy's still ripping in the States. But the yield curve in the treasuries, the 2 and the 10, is inverted by 40 basis points, which is suggesting a sort of like a severe recession. So what are we going to get? Are we going to get this soft landing that the sort of the Federal Reserve is sort of like, you know, promising us, or sorry, as the equity market is promising, or are we going to get something a bit more serious and it's going to be a bit of a sharp recession?
I think we always have to be careful with jobs, because we always need to remember that jobs is a lagging indicator, and it's been really distorted even more this time by the pandemic. We never had anything like that before, the economy stopping and starting again. It's interesting, I saw a piece the other day where someone had done a big dissection of the numbers, and there was a lot of part-time jobs being taken up, which are included within there. And they were basically saying that it looks like there's people taking 2, even 3 jobs, which obviously with inflation like it is maybe people, you know, having to take extra jobs to make ends meet. So I think we do have to be a bit cautious. Of course, what the Fed will be concentrating on those numbers was the average, was the wages number, the average earnings, which are, you know, admittedly still way too high against their 2% target. So it was
5%, weren't they? The wage rate was 5%.
Yeah. So it's way too high against their 2% target. So I think that we do get another rate rise, but I mean the market, as we both know and everyone knows, is searching for that peak in rates. And I think we still are on target for that. If you look at the indicators, the activity indicators like the PMIs, the European PMI composite was below 50, the US one was below 50. The ISM was a bit more positive, to be fair, in the US. But I'm still going, to answer your question, I'm still going for a soft landing in the US, very much so.
Yeah, no, I'm on the same part. I actually think they're sort of like they reconcile, because I think the market, the smart money, realizes that actually the Federal Reserve will reduce interest rates, not next year because of a recession. They'll reduce interest rates because they can, as inflation falls and it starts to roll over. In terms of you know, on commodities and more volatile food. But how long do you think it's going to take to get back to that sort of 2% of the target, or will it ever?
It's going to be quite sticky on the downside. I think it probably comes back to around 2 to 3. I mean, is inflation embedded in the system again now? I think it pretty much is. But let's look at where some of these big drivers of inflation are. The oil price is now back to where it was pre-Ukraine. The wheat price is back to where it was pre-Ukraine. Food prices are still rising double-digit year on year, though, even with that. So you know that's embedded in the system, and it's a lot more to flow through as well, which we'll see this autumn as you know the annual price rises come through from food manufacturers, etc., etc. But it's really energy that's driving that inflation at the moment, because it's the gas price that's driving it, coming out of Europe, and that's a global commodity. Europe's trying to buy gas anywhere it can from the world. So I think push comes to shove this autumn on that. We've seen that Germany, France are in pretty dire straits now. And the rivers are so low in France, they're having to turn down the nuclear reactors because the water's too warm, because they use the water for the rivers to cool the reactors. And they've even given them permission now to put the hot water back into the rivers now, because they weren't allowed to before, because they can't cool it down again because it's so hot. So you've got that issue, you've got the Rhine at lows, you've got big problems. I suspect, and it's not great really, but I suspect that come October, November, December time, when push comes to shove, Germany and France will just have to buy Russian gas. I mean, I don't see what their alternative is going to be really, because hydroelectric isn't filling. So that backup that they have in hydroelectric isn't there. Norway has said today that their hydro is down, and they'll be limiting exports of power as well. So it's all pretty dire on that energy side. And that's why I think inflation will be sticky on the way down, because the gas price will stay high, depending on what happens with Russia. But I don't think Germany will have much, I don't think they can have much choice really, unless they want to shut down their industry.
Yeah, I mean that certainly chimes with what the Bank of England was saying in their monetary report last week, that they were expecting energy prices to not increase but stay at sort of elevated levels, sort of $90 to $100 per barrel for say crude and stuff. So on that, we just turn into the UK. What was your sort of take from the 75 basis point increase? Are we going to
50 in the UK. 50 in the UK.
50, yeah, sorry, 75 in the US, 50 in the UK, but we've got a flat yield curve in the UK. Now, where do you think we're going to land on that one? Because even the Bank of England are saying we're going to get 5 quarters of negative GDP growth, albeit shallow when you add it all up. But even so, it smells as though we're heading in the wrong direction.
Yeah, well, you've got, I think it's the CPI it's their forecast on CPI which were the most damaging. I mean, it's going to peak over 13 in October, but it was still going to be at 9.5 in Q3 next year. And I don't know really how that can chime with rates of 1.75. And I know you mentioned 75 basis points. We have to contrast with what the US has done. It's done 2 75 basis point rises. Now, they did start too late, but they got on with it and they put those rate rises through. So they're 2.5% now on the Fed rates. And they are going to be at the neutral rate. And the UK, we're at 1.75, but we've got inflation through the roof still. They did 15 basis points to start, then some 25s, and they did 50 last time. Now, if anyone follows my Twitter, I've been quite critical of them as well, to be perfectly honest, of what they've done. And they clearly didn't act quickly enough. Remember Haldane, the former Bank of England economist, who I really respect, he resigned last summer to go into charity work and the voluntary sector, when he said that this isn't transitory, we should raise rates. So I don't think really they've got the balls, to be honest, to take rates much higher than 2.25 maybe, especially when you start seeing a recession, which they expect to start in Q4 this year. We've got GDP numbers this Friday, so I'll be interested to see for Q2, interested to see what they come out at. I don't think they will be able to take them too much higher. The question will be what government does, and that's anybody's guess, really. If they start cutting taxes, then arguably it might have to take them higher, because if sterling falls when we cut taxes in the UK because of balance of payments pressures, etc., then we could we'll see more imported inflation, won't we? So it's a very difficult picture for UK and UK consumer and UK consumer stocks, because we've got the energy price rise to come through August for October, i.e. gas pricing in August. Now they're going to do it quarterly as well. So then you'll have another one, August, September, November for January. So that could be the worst time to do it, setting it in November, because you're going to have the gas price set off what's happening in Europe. So inflation in the UK, whereas I think in the US it could come back. It'll be relatively sticky, but it could come back relatively fast. And I think in the US, the big number really is the October number, because if you look back to 2021, the month-on-month inflation rate, CPI in October, was 0.9%. That will drop out in October. So that I can't see in the US us seeing inflation being anywhere 0.9 in October. So I think we could see quite a marked fall in inflation coming through come this autumn in the US. And what will that mean? That will take all the pressure off them raising rates, and what the market will be looking for, that peak in rates, peak in inflation. It's the same thing, let's be honest. Peak in rates, peak in inflation. It looks a lot more rosy for markets. And of course, we had that second quarter GDP number, which was negative in the States as well. So you've got a technical recession. Everyone's arguing, is it, isn't it? Well, in my textbooks, 2 quarters of downturn is a recession. So it's a lot more positive for equities, to be blunt.
I mean, I actually think certainly, the Federal Reserve and the Bank of England and the other central bankers around the world, people are actually missing the point here, because yes, they're supposed to be independent, okay, but frankly, they're still government agencies. And if you were a cynic, and I am always a cynic in these sort of things, if you were a politician or the head of the Treasury or the, basically Rishi Sunak or anybody like that, and you've just built up an enormous fiscal deficit, and also debt to GDP balance at 100 or 120% or even 150% in Italy. And the first thing you want is some inflation to reduce that percentage down. And yes, you could. The central bankers can all be sort of like kicking and blinding and swearing about essentially the higher inflation, but that's frankly what they want. And I think the market's actually misread that that they give them a hard time, but actually I think the central bankers have just followed what they've been told to do as much as anything, and keep the party line and to reduce that deficit, because who's going to be the biggest winner on inflation? Yeah, it's going to be the governments around the world, because it gets their balances back into passion. So
I think you're right to be cynical about it, but I think we've got a slight issue in the UK with that. If the Bank of England's right, and let's be honest, they've been completely wrong with all their forecasts so far, but if they're right, you're going to have triple lock going up by double digit 2 years in a row. You're going to have benefits payments going up double digit 2 years in a row. Index linked gilts, which is roughly a third of the 40% maybe, I think it's about a third of the issued gilts. They're going to be going up by double digit as well.
Yeah, but who owns the debt though?
Well, but the trouble is for them, that is a really bad side on the government balance sheet. If you're having a recession at the same time.
Yeah, but basically the Bank of England owns a third of the
know, you're right, it does.
You're joking, and it's even more.
The government balance sheet will look bad, I'm afraid. It will look bad. It's the recession that kills it as well, because receipts will go down as well. So payments out are going to go up, receipts are going to go down. It's not a great business.
In nominal terms. I mean, I'm with you. Where do you want to put your money? In equities is a pretty good place, I think.
Oh yeah.
I think that's when we come. If you don't want to be in bonds and you don't want to be in cash, if the central bankers are playing this game such that the politicians are essentially telling them that they want this really, it helps them in the longer term, then you want to be in risk assets where you've got some inflation protection, which just actually, before we move on to sort of like in potential areas to invest, the other big thing we haven't discussed since our last one is sort of key takeaways from the Q2 earnings season. What have you sort of like seen on that basis?
It's been very interesting. I think margin pressure is definitely there. We've had companies have been taking the largest share of profits for a few years now. And I think that, as we see, the power of labour is coming back now, so wages are going up. We've seen the companies that got pricing power, and some of those are actually expanding margins, for example, and at least maintaining them. The ones that haven't, seeing that big squeeze on margins. I think the one thing that we have seen with some companies, and it's worrying for those, is that we've seen some debt levels explode up for some of these companies. And this is not the stage of the cycle when you want to see your debt going through the roof. I mean, there's a company in the 250 XP Power where their debt's exploded up. Some of them have taken on excess stocks, obviously to protect against supply chain issues. You really don't want to see that. You've really got to keep a close eye on balance sheets in companies, I think, particularly as we go into the earnings season through September as well, because you don't want to see that debt side expanding up. So margins and balance sheet, I think, are the key elements I would take away from the earnings cycle. And you can see those companies who've got pricing power. They've put through the price rises. Some of them have maintained the cash margin, cash profit. So actually, you see a little bit of a decline in the margin, because the way the maths works on it. But the cash profit is still the same, which is good. So that's fine. Others have actually expanded their margin in effect. So I think that's really what we've seen in the earnings season, those two things.
And one stock which obviously fits that bill, actually, which has improved its margins, is a Singer's client, is Venture Life, actually, because in the first half, it put a trading update and it's seen its margins increase. It does have pricing power. It's sort of like, all things sort of like consumer OTC type healthcare products. And do you want to quickly take us through that one? Because it seems to be on track, but the market has been pretty sort of like, I don't know, sitting on its hands in terms of recognizing the upside. And I know the chairman, who has recognized the upside, went heavily into the stock and has bought a shed load of shares.
I think part of the thing in the market at the moment is there's not a lot of new money being put to work by institutions because, as you and everyone and a lot of the viewers will know, there's been redemptions from UK equities going on for the institutions rather than money coming in. So not a lot of new money to put to work. That will change as we just said, people get more positive on equities, the flows will come back and people will take new positions. So that holds the whole market, not just the venture life, to be honest. But I think, yeah, the venture life is a story about delivery now. It's delivering those numbers and hitting those numbers that they've put out that are in the market now. I mean, they've appointed out new distributors in China where they had a little bit of an issue there that the old one wasn't delivering. So they've sorted that out, got the new distributors in place there. I think healthcare, as we know, is an area that spending is continued to grow. The world, it's ramped up because of the pandemic, and it's not going to ramp down again. Let's be blunt. That people are going to continue to gain. So the shares very much are undervalued at this level. If you very much look at our analyst forecast on that and target price. So I think, yeah, that's it. Healthcare is a good area to be looking at, I think, for stocks that will, in what's going to be, markets get more positive while the economy is still going down. So you have to remember that we're still going to see profit warnings coming out for companies if we're going to go into a downturn stroke recession. So you want good quality earnings, quality growth, really. I think secular growth is where you want to look.
And I think that the sort of problems that venture life has incurred recently in terms of the supply chain, they did mention they were seeing a lot of that as plateaued or starting to ease as well. And now that the Shanghai lockdowns are sort of like finishing, they should be able, their distributor out there, San Marcan, should now be able to sort of like sell through. So assuming that we don't go into further lockdowns and the supply chains continue to normalize, then actually with pricing power, I mean, on just over a 5 times EBITDA multiple compared to more than 10 times, I mean, I'm with you. I think your analyst is right on this one. 65p target price compared to a share price of 34p. And as I say, I'm not surprised the non-execs or like, Chairman Paul McCreevy put in 100 grand, to at 35p to buy in,
Yeah. Yeah, I think that's the other point, I think, from the earnings season, actually, that I forgot to mention, that supply chains are now easing. It's definitely easing now, that side. I suppose, Powell said it in the States, didn't he? He said that we need a little bit for supply to catch up with demand. And I think that's a feature of one of the perverse effects of free money, as it were, that we've had, which has now ended in 2022, was that it basically crowded out, as it were, capital investment by companies because they weren't getting the return. So we've had 15 years of underinvestment. So now I'm very bullish on capital expenditure and companies and reshoring and nearshoring, because that's going to happen. People want to get supply chains shortened and closer to home. So I think that's another feature that we'll see very much going forward. Yeah,
and one stock, which came out with a positive trading update this morning, that fits perfectly there with pricing power, margins, and infrastructure and reshoring and infrastructure, is actually Crestchic, because it does basically mission critical load banks that sort of like test the reliability of electrical grids and networks, and it's a power reliability firm. And they've just come out with an unbelievably strong trading update in the first half. And, I've lifted my expectations by sort of 20% up to sort of like an EBITDA of 10 million. And they're just getting huge. Their main sort of growth drivers have been data centers. Clearly, that's going to carry on with digitization, renewables, clean energy, because that impacts the sort of like, battery farms and solar and wind and stuff like that. But they're also seeing, as your point, in terms of the other infrastructure is now coming back, because essentially it's allowed engineers to get onto site around Asia and Middle East and people like that. So they're seeing a lot of sort of mission critical, sort of like facilities having to be tested, basically in sort of like extractive industries, in mining, in oil and gas, but also
they're going to invest, aren't they?
Yeah, well, that's right.
As well.
Exactly, yeah. And so, their demand is off the charts, and their biggest problem is meeting that. And they are starting also to see that, so supply chains alleviate, and they're putting on some more factory capacity out in their facility at Burton-on-Trent. So they're basically firing on all cylinders, and their ESG. So, and what was quite interesting, actually, the shares are still pretty modestly valued, even if, I mean, they've gone up a bit this morning, but they were £2. I think they're about 2.20 at the moment. And I mean, I have a modest fair value of £3.30 on that one. So again, that's sort of like an area that is mission critical, plenty of pricing power, huge demand. And it's that infrastructure sort of area that you talked about. You know,
it's secular growth, isn't it? It's secular growth. We're talking about electrifying the world, as it were. Everything is going to go electric. Well, Crestchic's a great play on that. Yeah, another one on that I like is another one on the infrastructure kind of play is Eneraqua, which I've mentioned before. But they came out with some cracking numbers, new orders coming in. Literally, what you want now is also what you want if you've got a bit more difficult economic environment is order books, full order books. Now they're full out. They're pretty much sold out for this year. So that's to January 2023.
And what's their USP? What's their unique?
The USP is basically they will go in and they project manage the work. They use subcontractors to do the work. They will go in if you've got a kind of mansion block or something like that, or a council block.
So you're home, Jamie.
Yeah, right. Okay, you've got a council block, and it's got combined heat and power system in there for the whole block. A lot of these are 40 years old. Can you imagine how inefficient they are? They will go in there, they will save you 40 to 50% on your energy usage. And one of the things they've got is they've got patented, which they manufacture themselves, flow control valve. It's not a valve, it's a flow control device, they can say valve, which basically on water will save you big time on water usage, but also they sell it into hotels as well. And if you know you go in a hotel shower and someone else turns a shower on, the power goes off, the water drops and stuff, there's no water pressure and everything like that, which is hopeless for customer service. This maintains even flow, not pressure. The pressure drops a little bit, but it's still very good. Flow. So this flow control is crucial. For example, it's also being used in agriculture. There's trials going on because you know when you see the big water sprays in the fields, watering the fields.
Irrigation.
Irrigation, yeah. They squirt the water out, but it's all the flow is not constant. So one area gets a load of water, another area gets none. There, it's being tested by in Spain and in India. Started to buy it now. They're selling into India already for making sure you get even watering. Now this stock, so as I say, fully covered for its full year January 23 revenue. It's taken orders into 2024 year now. Trading on a P of 10.5 times.
Yeah, no, I saw the valuation. I was thinking this is a fabulous sort of like widows and orphans small cap that is priced at a really low valuation.
Yeah, 7.5 times EV EBITDA, net cash.
Yeah, so, I know it looks a nice place to be, and if it's got a bit of IP, it's got obviously some pricing power as well.
Patented in IP, yes, and they manufacture them themselves in Spain as well. So that's a nice company there to have to just remind everyone about. Interesting today as well. Just we saw a takeout today of RPS talking about secular growth.
Oh right, I didn't see that.
Yeah, RPS taken out at a 76% premium. Now I think we mentioned it before.
Yes, we did. Yeah, it's an environmental consultancy, isn't it?
It is, and we said how what they were doing was they were putting through rate increases ahead of wages, and wage growth was 5% plus. So now they had a cracking set of interims today, and you might remember WSP used to be quoted on the UK market. It was taken out by a North American organisation. They changed the name to WSP. They've taken out RPS at a 76% premium.
Who bought it?
WSP.
Oh, WSP. Oh, right. They bought it. Okay, right. So it's the same guys. They're going to right.
So they bought it. I mean, it's a bit of read across, I think, to Ricardo, which I don't know whether you look at. But the takeout on RPS was somewhere between 12.5 to 14.5, depending, because they've done a 12-month historic. But actually, if you look forward to the year end, and there might be an upgrade on the numbers today, it's more like 12.5 times EV EBITDA. Ricardo trades on 6.5. And Ricardo is very much an engineer's consultancy business, tilting itself into renewables, EV. So I think that's quite an interesting little story there as well.
Another one on the sort of the M&A theme. I'm on with you. I think there's lots of sort of like hidden gems within the UK market that overseas buyers will be having a look at. Well, there's one company called Fintel, which is effectively a category killer in all things financial services, information and data in the UK. And its main customers are sort of IFAs, intermediaries, and also the product providers. So your likes of Aviva and Schroders and people like that. And what it gives them is a number of things, but essentially for the product providers, it allows them distribution to the end consumers, and it also gives them insights into improving and designing their products, so it's better outcomes for individuals. And then for the IFAs, it gives them, and the intermediaries, it gives them two things. It gives them reg tech, so all the different regulations which change. You know, we've seen it through RDR, but also more which coming through now is it consumer duty, isn't it? The new one coming through. So it gives them, improves how they actually work, but also more importantly at the front end, it improves their service and the advice they can give to consumers to give better outcomes.
It's essential, really, isn't it? Especially
it is, so they've got this end-to-end proposition, and then 66% of that is SaaS or distribution as a service. So it's all recurring revenue streams, or 2/3 of it is. It's high margins, it's cash generative. And this is
what's the trade-off?
Well, this is it. You see, this is the key. You see, because you whet my appetite with a bit of M&A. Now it trades on, and this is what the market's missing. It trades on 10 times EBITDA. Now, a couple of really smart investors from Gresham pointed it out to me, and Euro Money Institutional Investor, who are effectively a financial services provider in all things sort of like asset management and stuff like that. They were bought out just recently at 22 times or 22 times even, also double that. Now, what that means is given this, in my view, Fintel is basically undervalued. It's trading at roughly round about sort of like half of what a takeout value would be. And it's growing its core business at round about sort of high single digits. It's making, sort of 25-30% EBITDA margins, over 100% cash conversion. And the important bit, it's got great visibility and is really sticky, because if you think about it, because it does this end-to-end service with all the insights and financial information to consumers, to IFAs, to product providers, then it's the only game in town, because you can't
really go away. Once you're signed up, you're not going to move somewhere else, are you?
No, well, it's all the software. And so the key trick is to monetize the software, monetize the data and the insights and the research they produce over the software to a one-to-many model, which is what they're doing. And they've got cash on the balance sheet. They've got about 8 million of cash on the balance sheet. So it was an interesting one.
It ticks the boxes, doesn't it?
It was an interesting one.
Earnings visibility.
The boys at Gresham, who are notorious sort of like private equity kind of investors, they sort of said, well, okay, this might be an interesting
like that one. Yeah,
that's right. And then there's another one I know you like, which is a great story that I haven't really looked at it in detail. It's Orphan.
Yes, Orphan. I think this is kind of a business that's been really invigorated by management change. I think the new management had gone in, a guy called Mo Khan, who has really got a cracking background in CROs, which is contract research organizations. He's been very successful in that. Let's be honest, we had a face-to-face meeting with him a few weeks ago, maybe a month ago now.
They do challenge vaccine trials, don't they?
It is. That's what they do. They do challenge trials, and that basically is human challenge trials. So he's gone in there with a great background. He's made a lot of money out of CROs before. He didn't need to go back to work, I don't think, but he saw this and just said, "There's so much I can do in this business. I'm going to go in and have a fun time here, really driving this business forward." So what he's doing, he's rapidly accelerating the business. They signed 3 flu challenge trials up recently. That doesn't, because you have to plan these out, that kind of puts the revenue through into 22, 23. It's profitable. It's on a relatively high rating at the moment, around 20 times PE. But I think that will come down rapidly because the business is growing very fast.
What's interesting for investors just to realize is that because we've had new technology, particularly sort of mRNA, we've seen that with the COVID vaccines, that's improved the efficacy of these treatments. Now, the old sort of like way of doing vaccines was that you got a live virus injected into people, but the efficacy of these things, I mean, if you look at the flu jab, the efficacy of flu jabs is 50 to 60%.
Yeah, right.
It's good, but it's rubbish. if you see what I mean. And now
yeah.
the new mRNA COVID are 80 to 90%, and certainly the ones from Pfizer and from Moderna are. And so what that means, in my, you know, as I'm with you, is that this isn't just a normal CRO. This has actually got, because it's quite difficult to get regulated.
You need the models. They've got 8 controlled human infection viral models, and that's key. They've taken years to produce. They've got those. They've got the infrastructure to be able to do the tests, and they've got the people coming in. You know, you get paid to do these tests, whether it's students or whatever. They've got the people coming in to do these tests, which is crucial for these. You know, the recent one they signed up was a US biotech for a £6.2 million contract.
And also you need to be regulated. That's the key.
Oh, totally.
I think they're the only one in the UK. In fact, maybe the only one in Europe who's regulated to do challenge trials, because this is seriously dangerous if you get it wrong.
You get it wrong. So I really like it. It's management change, which is great. He's driving the business hard. You've seen he's winning the contracts. So I think we'll hopefully see in due course upgrade momentum coming through. And he's building that order book, which is one of the themes we've talked about today, isn't it, really? Companies that have got good order books. So in a more difficult environment, you get a bit of security on those earnings.
And tell me, Jamie, have they got pricing power by any chance?
I think they have pricing power.
I mean, if you're a pharmaceutical or a biotech business that has just spent literally billions developing this new vaccine, are you that bothered about playing a 4 or a 5% inflation? You want, because a challenge trial accelerates that whole development, doesn't it?
Yeah, it does. Yeah, it does. It's not something that you specifically require for approval, but it's obviously it's very helpful to have, and it's being used a lot more now. And it's becoming a bit more of a, especially with the flu. Obviously, flu. Everyone's worried about the flu season and flu now on the back of COVID. So yeah, I think it's in a really nice place. And the key is it's got the person running it now who knows how to make money in this industry.
Yeah, no, I mean, thanks for raising that, because I hadn't really seen it and appreciated it, but it does look, now that it's come down, it looks a cracking business. What and just to finish on, what another stock that maybe investors want to have a quick look at, that's sort of like a slightly more, just smaller cap, it's sort of like about 15-20 million, is Zenova, which again came onto the market quite quietly last year, and a really astute investor, Paul Jordan of Amati, pointed it out to me. And they've got unique IP that essentially, the shares traded about 18p at the moment. They've got unique IP that basically creates paint that is insulating and fire retardant, and that has a number of things. Obviously, with the Grenfell, problem we've had with this basically, stops fires on buildings and stuff like that, so improves the sort of safety profile. But also with the environment, in the cost of living crisis, if you've got insulated paint, essentially both indoors and outdoors, then in the winter it keeps the heat in. And in the summer, when it gets too hot, as it did to 31 or 41 degrees in London, it keeps the heat out and keeps so that's, and those they're already selling that through in the UK and through distribution in abroad. And then they've also got this other really quite unique retardant that, and it seems simple, but they've got basically a liquid patented that puts out all types of fire, so electrical, gas, just normal fires and stuff. So you don't need 4 or 5 fire extinguishers. You can just do it.
Oh, right, you just have one.
Yeah, exactly. And that's what, and now this is a small business, so it's, it's early days. But if you actually believe what the actual broker's doing, next year they'll be profitable and cash generative in 2023. They've got cash on the balance sheet so they can get themselves through to it. And they'll have an EPS of around about 3p. Now, if you given their growth is just going through the roof, if you put a 20 times PE multiple on a 3p with cash on the balance sheet, you get 60p compared to, less than 20p at the moment. So it's one of those which is early days. But it's sort of flowed under it's flowed under the radar screen of most investors, myself included. It's only Paul Jordan who sort of pointed out to me, and it's certainly something that is worth having a good sort of look at. It's got pricing power, it's got plenty of IP, basically. So bring in all. I mean, I think that was 6 great stocks, or seven even, with the sort of like the one with Ricardo. So we've got, you know, plenty of stocks to have a look for. So overall, by the end of the year, Jamie, just coming full circle, given where we are, if we think there's a soft landing and valuations, yes, they've come back quite a lot in July. You must be pretty optimistic for the second half.
I went bullish. I went bullish and said it's time to put money to work on that Q2 US GDP print. Basically, as a house, we basically said that's it now. We can see the top in sight. You look at that 0.9 print from last year on CPI in the US in October. I think, you know, it's time to put money to work now. And its quality growth is where you want to be at this stage in the cycle. So just to recap, you don't want to be in indebted companies. You want to be in those companies who've proven themselves. They've got order books, secured order books, recurring revenues. That's where you want to be at this stage in the cycle, because you will see you'll see rating expansion for those companies, particularly in the mid and small cap, where we've obviously seen the big corrections in the UK from here. So yeah, your question, when we see markets higher for those from there, it's a little bit tricky in the FTSE, to be honest, in the FTSE 100. The FTSE 100's done very well on the back of the mining stocks and stuff like that. But no, I think higher from where we are now at the end of the year, definitely, yes.
Well, that's a great point to finish. But before we do, I'm going to put you on the stump again, because you were dead spot on last time. And I asked you last time what the US CPI, and you said it was going to be a little hotter than it was, and it came out quite a lot hotter than the expectations. Now, tomorrow's CPI headline is expected to be 8.7%, having been 9.1% last month. So what's it going to be, higher or lower?
I think it'll probably be rough. Hopefully they kind of computed it right this time. I think it will be there, could even be a bit lower, because look what's happened to the gas price in the US, the gasoline price. Look what's happening to used car prices. I think we should start to see that coming through now in the US. So I don't see a huge surprise to the downside. If it does come, I mean, if it shocks to the downside in a big way, the US market's going through the roof. I mean,
I was going to say, is if you're right, everybody's going to have big smiles tomorrow.
Yeah.
Brilliant. You've made my day there, Jamie. So thanks very much again. Terrific insights, and hey, you've whet my appetite for our September conversation. Come back with some more brilliant stocks, please.
Will do. Thanks, Paul. Cheers.
Thanks, bye.
Bye.